Welcome to the cutting edge of the global awakening.
In the councils of government, we must guard against the acquisition of unwarranted influence by the military-industrial complex.
Well, it looks like the North Tower of the World Trade Center has just completely collapsed.
The U.S. dollar's status as the preeminent reserve currency is under attack.
This is a mathematical fact. Tens of trillions of dollars are being extracted from the United States of America.
You really want the truth? Then just follow the money.
Welcome to Follow the Money Radio, a broadcast dedicated to your personal, spiritual, and financial liberty. And now, here's your voice of reason in the midst of global chaos, economist and best-selling author, Jerry Robinson.
Greetings, friends. Welcome. FTMdaily.com. FollowTheMoneyDaily.com on the web. So glad that you're joining us this week, every single Saturday morning, bringing you information, news, and analysis that is hard to find other places. It's possible, I guess, but we put it all in one place for you. Let's talk about a lot of things. We have so much to cover, so let's just dive right in. First of all, the markets. The stock markets are, well, they're frothy. They're booming. They are attracting capital unlike they have in many years, as the desire for yield, the desire for return is causing many people to cash out their bonds, take money off of the sidelines, and pile it into the stock market. Now, this week alone, 8 of the 9 sector SPDR ETFs hit brand new highs. The financial sector ETF hit a 4-year high. The energy sector ETF hit an all-time high. The healthcare sector ETF hit an all-time high. Industrial sector hit an all-time high. The materials sector hit an all-time high. The technology sector hit a 4-year high. The consumer staples sector hit an all-time high. And then we have the NASDAQ, which set a brand new 4-year high. And both the Dow Jones Industrial Average and the S&P 500 now sitting at all-time highs. Meanwhile, gold crossed below the $1,300 level this week and closed and settled around $1,290. The euro crossed below the 135 level, which is important to pay attention to. And oil also crossed below an important key level of $95. You're probably seeing the prices at the pump begin to go down. We expect that trend to probably continue for some time, as there is a lot of pressure based upon inventories and all of this with energy and oil. But here's the question. What are the fundamentals that are driving this economy? What are the fundamentals that are driving the stock market higher? As we look and see that all of these stocks across the board, with very few exceptions, we can look at the mining sector, we can look at a few other areas, but for the most part, we are getting all-time highs or new record highs as we move forward. What are the underlying, what is driving this? What exactly is driving the financial markets higher? Some people point to record corporate profits. Others point to evidence that the economic recovery is finally taking hold. Some are saying, well, I guess Armageddon is not really going to happen. But friends, this is exactly what we wrote about in our book, Bankruptcy of Our Nation, that we would experience a crash, which we did, and then we would experience a sucker rally, and then we would experience finally a massive crash. And right now we are moving, in my opinion, in my personal belief, is that we are heading towards brand new all-time highs consistently. That the Federal Reserve is, in fact, targeting the stock market as its end goal. Now, it's not saying that, but it's attempting to drive stocks higher because they are interested in creating the wealth effect to get you spending money, to get you consuming more, to get you going more in debt, to drive things higher. Now, personally, I believe that this stock market is going much higher from here. Now, will we get the scary 5 to 15% corrections along the way? Of course. All along the way up on this upward trajectory that we're on. I mean, we're in the middle of a 6-week uninterrupted increase in the stock market. These are rare times that we see this. We will see a pullback, but I believe that these pullbacks that we're going to see are going to be temporary as the stock market continues to march higher. We're probably going to see more than one. We're going to see several different corrections, a 15% correction or a 5% correction. We're going to see the market pull back along the way. Nothing goes up in a straight line. But this bull market that we are in currently, and let me put it this way, we are currently in uncharted territory. I don't know how many times that I have said this, but there has never been anything like what we are experiencing today in monetary history. When I was going to the University for Economics and studying, one of my favorite topics was the history of money. I'm just a big history buff, and when you combine the financial world with history, I really get excited. That's just something I like to read about. And I would love to read alternative histories of money. History's a funny thing, It's nearly always written by the victors. Those who win get to tell their version of events. It's so true. So history is written by the victors. Think about this. I was talking to somebody the other day, and I said, imagine this movie. Imagine a movie. The film rolls, and the very first scene you see is a beautiful family living in the woods. 2 children, their parents, they're playing, laughing, eating. They work together. They share dreams together. And then suddenly, up over the hill, there's a loud sound. It's the sound of ships and the sound of men's voices. And lo and behold, it is the colonists from Britain making landfall on the American continent. Now, you have never seen a movie like that because we don't identify with the losers. We identify with the victors, if you are a victor. Why? Because we have learned history quite the opposite way from this particular version. We learn from ourselves. We learn from the victors. Instead of focusing upon the Native Americans, our education comes at everything from the colonist perspective. That's not an opinion. That's the facts. The victors write the history, and history tells us that the victors, when they write history, it's often filled with an abundance of accurate details. However, there is a lens that is employed in looking at that history, and when you look at history through that lens, the entire world looks different than it does from the opposite viewpoint. So saying all that, it's unlikely that you will ever see a movie that views the Indians' plight through early Native American eyes because they lost. They're the losers. And the writers of history simply say, too bad. Better luck next time. And I think that is why I really enjoy reading alternative histories, because it allows me to see both sides of the coin, so to speak. It brings a much-needed balance. Plus, there are, quite frankly, numerous lessons contained in the alternative histories that are missing from the more popular and widely accepted sorts of history. Now, why am I saying all this? Why am I talking about the Native Americans and history and viewing history from a different perspective? Friends, my point is that there is another history of money. There is another history of the Federal Reserve. There is another history of the Treasury Department that the mainstream media does not tell you. Most of the mainstream news treats the Federal Reserve as just another independent government agency. This view ignores reams of evidence to the contrary. The Federal Reserve is a private institution. It is not just a private institution, though. It is a shadowy kind of private institution. It operates in the shadows where the light cannot get in. And while it is the most powerful, there are many other of its kind around the world. The European Central Bank, for example, the Bank of Japan, the Bank of England, along with many others. I'm talking about the world's central banks. Now, there are 2 versions of every story, at least. And if you study the history of the money changers and their interaction with various governments of the world, it's absolutely fascinating. And when we take a look at what's happening with the Federal Reserve, there are 2 ways to look at this. You can look at it from the official mainstream view that the Federal Reserve is simply here to do its job and it's here to provide maximum employment, and it's here to provide price stability. But there is a very different approach to understanding the Federal Reserve and its intentions. Why am I talking about the Federal Reserve right now? Because the stock market is rising dramatically higher, but there are no fundamentals to drive it higher. We're going to talk about that in a minute. But research released by Fed economists last week show that the Fed believes that low interest rate policy over the long term is the best medicine for the economy. And according to a report by the Wall Street Journal last week, Federal Reserve officials are debating whether to shift their guidance on interest rates. They have been saying that they won't raise rates until the unemployment rate drops below 6.5, but now it's very possible they're going to lower that threshold to allow them to continue to keep rates lower for an extended period of time. Now, weighing in on much of this was Federal Reserve Vice Chairman Janet Yellen this week, who is preparing to take the reins from the current chairman, Ben Bernanke, once his term at the Fed ends. That's going to end at the end of January. So Janet Yellen testified at her Senate confirmation hearing this week. She defended the Fed's bond-buying stimulus program, no surprise there, saying that the only way to restore the U.S. economy back to a state of normalcy is through a continuation of the Fed's current quantitative easing program. Let's hear a clip.
A strong recovery will ultimately enable the Fed to reduce its monetary accommodation and its reliance on unconventional policy tools such as asset purchases. I believe that supporting the recovery today is the surest path to returning to a more normal approach to monetary policy.
Now, this is your first clue that Yellen has no plans on scaling back the Fed's money pump anytime soon. And as we've been telling you right here on this show for months, we not only expect the current money printing to continue, but actually to increase. Currently, the Fed is buying about $85 billion worth of bonds every single month for a grand total of around $1 trillion per year. Now, I've been going on the record for the last several months saying that I believe that that number, that figure, $85 billion a month, is low. And that, in fact, the Fed is going to raise that rate possibly as high as $150 billion per month. They're going to increase it. Why? Because the Fed's goal of supporting a quote-unquote economic recovery will lead them to increase it. Because it's not working. The $85 billion is not getting them close enough to their goal, and we are definitely on the cusp of seeing a much more aggressive Fed policy, which is going to drive stocks, my friends, even higher. And that is why I have been saying that the fears of a taper, a Fed tapering, that is the Fed coming in and saying, we're going to stop printing money, we're going to slow down the printing of money, we're going to not print as much money. Those fears are overblown. There's really no foundation for that to even exist. The Fed is telling us, we'll listen to what they're saying. They will tell you there is no economic recovery. Oh, sure, there's been a few green shoots here and there, but how many years have we been hearing that? And just because the stock market is going up doesn't mean anything about the overall economy. It doesn't change the fact that we have a national debt that's $17 trillion. Doesn't change the fact we have $120 trillion of unfunded obligations. So Yellen was later asked directly about the timing of such a taper, because many people still believe that the Fed is going to taper. And Yellen was asked directly about this by Republican Senator from Idaho, Mike Crapo. Listen closely to her answer, because it's very revealing. Roll the tape.
Do you have any estimate right now as to when there may be a beginning of the tapering?
Well, we, at each meeting, are attempting to assess whether or not we have seen meaningful progress in the labor market. And what the committee is looking for is signs that we will have growth that's strong enough to promote continued progress.
So when will the Fed begin tapering? When there are signs of meaningful progress in economic growth that will point to continued progress. If that really is what they're waiting for, the taper is a long way off. You have the official unemployment rate currently at 7.3%. That's the official rate, by the way. You have the official youth unemployment rate at well over 15%. And remember, these are just the official numbers. These figures are the ones that have been scrubbed clean for mass consumption. If you factor in other metrics like the U6 unemployment rate, which is currently 13.6%, or the labor participation rate, which just continues to plummet to multi-decade lows as people are no longer in the workforce. The number of people in the workforce is dwindling. You get a much different fundamental story about what's driving this economy. U.S. productivity, which is the real value of output produced by a unit of labor, has been stagnant. Hourly wages are stagnant. America's personal savings rate is dismal. Existing home sales are slowly improving, but pending home sales are weak, and they're in decline. Figures on new home sales are near 30-year lows and nowhere near a recovery level. Just because the bleeding may have appeared to have stopped doesn't mean the patient is well and can get up and go home. America's debt to GDP level, it skyrocketed from just under 65% back in 2008 to now, 2013, it's over 100%. That is, every single year, our total economic output is equal to the amount of total debt that we have. And meanwhile, interest rates have nowhere to go but up. I mean, they are practically zero. And all of these economic structural problems that we have, these structural economic problems, all of this exists despite the fact that the Fed has pumped in literally trillions of dollars into the economy. The amount of money that has been injected into America's monetary system by the Fed is unprecedented. No one has ever lived in a generation like this. We have never been in a situation like we are right now. Now, I know people say, well, everybody says it's different this time, right? Different this time. We have never been on a total fiat paper money system the way we are today. The very first time that happened was 1971 when the dollar was cut from gold. Whenever Nixon came on, interrupted your Bonanza show and said, we're cutting the link to gold. The Bretton Woods system was completely destroyed. It was over. And since that time, every single currency has been free-floating against the dollar and nothing really tangible or valuable. And on top of that, now we are living in a time of great monetary production. And the fact that the paper money is getting much more watered down because they're making more of it. This is going to end badly. I guarantee it. I mean, history guarantees it. And so all of this money is being injected into the monetary system. And still, despite evidence to the contrary, Janet Yellen remains fixated on continuing the Fed's failed bond buying and zero-rate interest policies. Here she is explaining what her focus on the Fed's dual mandate of price stability and maximum employment will look like. Roll the tape.
We are very focused on achieving our dual mandate, which is we absolutely want to avoid deflation. We have a 2% price stability objective. We're trying to get the economy back to full employment. I do think we've made progress, but we're not there yet.
Now, as I said at the outset of the show, it's very likely that we're going to see a lowering of the bar from the Fed's target on unemployment. Previously, Ben Bernanke had stated that the Fed's immediate objective was to get the official unemployment rate down to about 6.5%. That was the target. We fully expect that target number to be revised lower down to about 6% in the coming weeks, and that's going to drive stocks even higher when they find out that the money pump is going to continue, the tapering is being delayed. And if the markets were any indication this week, investors love the dovish tone that Yellen is setting as the new Fed chairman once Bernanke leaves and exits office. And there is little doubt that we can expect a lot more of the same old tired policies from Yellen that we have gotten from Bernanke and his predecessor, Alan Greenspan. Except Yellen appears as if she could be even more aggressive. And so what is so amazing about this Federal Reserve is that if you ask them why they are doing what they're doing, they'll tell you that they're doing it because it supports America's economic recovery. But this is a purely Keynesian view that foolishly believes that the federal government can improve a failing economy through creative forms of intervention. Time has proven this to be wrong, and apparently we need more time to figure out that is not going to work again. One final clip from Yellen's confirmation hearing regarding her views on the Audit the Fed bill. This was revealing, introduced by Senator Rand Paul, this concept of, hey, let's take a look underneath the hood of the Fed and see actually where all the money's going and what this whole thing is about. Let's find out how much all of this information. We want to know everything about the Fed. Put it all on a piece of paper. That's gaining steam in the Congress, the idea of actually holding the Fed accountable. And that question, by the way, at the hearing comes from Republican Senator David Vitter of Louisiana, who's also a co-sponsor of the bill, S-209, Audit the Fed bill. And again, listen, you can literally hear the fear in Yellen's voice as she considers the shocking possibility that the Fed's activities would be monitored or audited by an outside third party. Roll the tape.
You've said in the past, quote, like Chairman Bernanke, I strongly believe that monetary policy is most effective when the public understands what the Fed is trying to do and how it plans to do it, close quote. A lot of us would agree with that, and many of us think the best way to get there is through true openness and transparency at the Fed, not just a better sort of managed PR campaign, but real openness and transparency. Would you publicly support S-209? I'm sure you're familiar with that. And if not, what specific changes to that would be required to earn your public support?
So I strongly, as I've indicated, support transparency and openness on the part of the Fed. And I think with respect to monetary policy, in terms of the range of information and the timeliness of that information, we are one of the most transparent central banks in the world. What I would not support is a requirement that any requirement that would diminish the independence of the Federal Reserve in implementing and deciding on implementing in monetary policy. For 50 years, Congress has recognized that there should be an exception to GAO ability to audit the Fed to avoid any political interference in monetary policy. I believe it's critically important to the economic performance of this country, and we've seen this around the world, that allowing a central bank to be independent in formulating monetary policy is critical to assuring markets and the public that we will achieve price stability. And I would be very concerned about legislation that would subject the Federal Reserve to short-term political pressures that could interfere with that independence.
So the corruption within the Federal Reserve is at outrageous levels. The Fed is not even a true government entity. It is an outside actor run by global mega banks that operate under the guise of a government agency. The institution's name itself is even laughable. The Federal Reserve. Well, it's not federal, and it has little to no reserves. In fact, it's often said that the Federal Reserve is as federal as Federal Express. Regardless, the distortions, the misallocation of capital created by the Fed has made investing for people like you and me difficult. Things aren't working the way that they're supposed to work because the Fed has stepped in and is distorting the markets. Stock prices have risen sharply, causing stocks to become vastly overvalued. Many of them are entirely overvalued. Value investors like Warren Buffett, for example, have been quite vocal about this. Speaking of Buffett, by the way, he and his firm Berkshire Hathaway are buying more shares of ExxonMobil, making a big bet on that company. And also another investment that was made and revealed this week is that by activist investor Bill Ackman. He is going long on Fannie Mae and Freddie Mac. Remember those two institutions that got hammered in the 2008 crisis? He's being aggressive with a 10% stake in each of the companies, believing that they're going to rally from here. They're both around the $3 level. So for speculative investors, it might be worth a look. All very interesting stuff. Well, let's turn to precious metals now. Gold closed the week at just under $1,300 at around $1,290.40 per ounce. Meanwhile, silver closed the week at $20.78 per ounce. Here to provide us with his perspective on this week's action in the gold and silver markets is our good friend, Tom Cloud.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
This week has been very uneventful as we've seen the price continue to go down after the figures came out on Friday that stated that 204,000 jobs were created when the experts had predicted 120,000. And for the ones of y'all that are on my email blast, y'all received Paul Craig Roberts, the head of the Treasury under Ronald Reagan's statement of how the numbers were wrong, and there was not even 120,000 jobs created. But because the public doesn't understand and they're busy trying to make a living, and we certainly understand that, the government sometimes gives out numbers that are actually detrimental to them and doesn't help them except on the short term to try to make the economy look like it's growing at a strong rate when it's not. And John Williams, that I've quoted many times on shadowstats.com, shows that the growth that was reported by the government on Thursday of 2.8% annual rate for the third quarter really was no growth at all. They just continue to jiggle the numbers to do. So what happens on the short term, people get excited about the economy growing. They forget about the debt. They forget about what serious trouble we're in. They forget about the debt ceiling coming on February the 7th again. They forget that our president can now print all the money he wants between now and February 7th, and it won't even count in the debt ceiling. He could technically print $2-3 trillion out there and just add to the debt and not have to get approved by Congress. So, you know, you've got to be very careful and watch it. And gold did go down and touch the support of 1269, and you know, hopefully it'll hold 1269. But if it does go below there, we could see it all the way as low as 1200, going back to the June low of this summer. But one thing I can tell you from my being at the wholesale meeting that we did an interview with Jerry 2 weeks ago, we are looking at next year being an incredible year for metals. Everything we're hearing, the sourcing of central banks to get more gold as possible. We're seeing a lot of people out there talking about the healthcare implementation, and there will not be a crash, that we're expecting eventually until the healthcare is implemented. They will do everything possible during 2014 to get it implemented, including quantitative easing continuing and even at higher rates. So we just have to really watch what's going on and totally ignore these figures on the long term and not get caught up that things are better, because they certainly are worse, not better from any economic indicator that you look at. But we are seeing here late in the week some covering on short covering, and it has bounced gold back up from its Monday, Tuesday, and Wednesday numbers. So hopefully, we'll see this pass, and we're looking for the first 2 weeks of December being fairly good, as they usually are, as the Chinese New Year, and they're getting bonuses, and we're seeing the end of the growing season in India, and that money being spent on gold and silver. So we are looking for a bounce the first 2 weeks of December, not knowing what will happen the remainder of November. And then, like I said, we're looking for a great 2014 after having our first down year. After 12 straight years up, this is the first down year for gold. So we're really excited about next year, and we're continuing to hear about shortages on the fiscal side. We've seen the U.S. Mint for the second straight week raise the premium on silver eagles, as they're having a very hard time getting physical silver to fill orders. The gold premiums have stayed the same from the U.S. Mint, but the silver premiums have been raised. If anybody has any questions for me, they can contact me at 800-247-2812. That's 800-247-2812. And if you're not getting our email blast, you can sign up for those. They're no charge, and we keep your name confidential at ftmdaily.com, and go to the Precious Metals button, and you can sign up there. And once again, we send out 2 or 3 emails a week of interesting things to do with the precious metals market. And for those that are looking for a precious metals IRA, you can call us and we can discuss how to set that up if you want to roll money over from a traditional IRA to a precious metals IRA. There are certain custodians you can use, and we're happy to discuss that with you. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Friends, it's no secret that the U.S. economy is in dire straits, but you don't have to watch this unfold in fear. You can protect yourself and your family with Jerry Robinson's best-selling book, now in audiobook format. Get the complete, unabridged, and revised version of Bankruptcy of Our Nation by Jerry Robinson, available in a brand new audiobook. We have had numerous emails pour in from listeners just like you, requesting Jerry's book in audio. Whether you want to listen in the car, at the gym, or on your iPad, we've now got you covered. Get the entire book for only $24.95. That's right, over 12 hours of Jerry Robinson's economic and financial education and practical strategies for only $24.95. Inside the audiobook, you'll hear 21 income streams you can create both now and in retirement, specific ways to inflation-proof your investment portfolio using our PACE philosophy, and the 5 levels of financial freedom that Jerry has personally used to build true wealth. Friends, you cannot afford to miss out on this information. Get Jerry Robinson's brand new audiobook, Bankruptcy of Our Nation, right now at ftmdaily.com/bankruptcy. That's ftmdaily.com/bankruptcy. With this week's Trigger Trade Report, I'm Jennifer Robinson. We ended the week with 8 stocks in play in the Trigger Trading portfolio. The overall markets made all-time highs this week, and so it makes sense that our portfolio had some big gains this week. Ticker symbol KORS has gained 7.27% since we bought it back on October 21st. Ticker symbol NI is up 1.2% after having been in play only 2 days. The big winner for the week was SQI, which was up over 10% in a single trading day. Ticker symbol LEE unfortunately was the victim of a steep opening dip on Tuesday and stopped out using our 8% stop loss order. 7 of our 8 active trades ended the week in positive territory. Trigger Trading is a service we offer all of our FTM insiders in which they receive Jerry Robinson's momentum-based trading system, complete with the daily trading idea, trigger price, stop loss price, daily commentaries, and status updates. If you would like to join the FTM Insider community and gain access to Jerry's trading system, you can learn more and get all of the details at ftmdaily.com/triggertrade.
Jay Peroni, certified financial planner, here with the idea of the week. This week we'll take a look at a highly innovative recreation company. I just love innovative companies. Innovation changes the game. Product innovation is all about the creation and subsequent introduction of a good or service that's either new or improved on previous goods or services. The company I'm talking about today is fun, they're interesting, and they're heading into one of their prime selling seasons, Christmas time. Here are 3 reasons that I love this company. It has a strong reputation for innovation and a newer product lines, along with a lot of acquisitions that have supported its strong performance in a difficult environment. It's been around since 1954. Retail sales have been impressive with an annual growth rate above 20% for each of the past 3 years. It's easily outperformed many of the other discretionary industries. Remember, this has been one of the most challenging economies that we've seen in some time, and this company has thrived. It also has established a reputation as a phenomenal executor. It's expanded its gross margins over the past few years, even when volume was weaker than anticipated due to the challenging economy. The higher margins have improved, and that's what it's allowed them to thrive. A top-tier management team has remained focused on lean production and operating as a best-in-class manufacturer. This is a company we can be proud to own, and the company I'm referring to is Polaris Industries, ticker symbol PII. It designs, engineers, and manufactures snowmobiles, all-terrain vehicles, motorcycles, personal watercraft, and it markets them together with related replacement parts, garments, and accessories through dealers and distributors. The company's line of all-terrain vehicles consists of 14 models, including general purpose, sport, and four-wheel drive utility models, and the company produces a full line of snowmobiles consisting of 33 models ranging from utility and economy models to performance and competition models. My 5-point stock inspection on Polaris shows us that the financial strength is positive, the valuation is positive, it's a good buy up to $140 a share, it's got positive momentum, the risk is neutral, it is a little higher beta, it's a 1.7, so a little riskier position. The earnings trend has also been positive, so it scores 4 out of 5. It also pays a 1.3% dividend, which is very attractive. The bottom line, Polaris is a great buy up to $140 a share. My 12 to 18 month price target is $220, so it still has a lot of room to grow. It's a highly innovative company and a perfect fit for our Contrarian Strategies portfolio. If you want more innovative stock picks, go to wallstreetrenegade.com and check out our Contrarian Strategies portfolio, which focuses on mid-cap, highly innovative companies. This is Jay Peroni, Certified Financial Planner, signing off for the Idea of the Week. We'll see you again next week.
All right, well, Jay Peroni is a CFP Certified Financial Planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
Today we're beginning a brand new segment entitled Stewardship 101, where we're going to be tackling different stewardship principles on this program. Today's nugget of wisdom is taken from the ancient book of Proverbs, chapter 22, verse 3, and it says there, "The prudent man foresees danger and hides himself, but the simple goes on and suffers for it." Now, what is a prudent man? What does that mean exactly? Well, it simply refers to wisdom. A prudent man is a wise man. He's quick to listen, he's slow to speak. He's sensible, but he's shrewd. And the prudent man loves to surround himself with wise counselors. But ultimately, he knows his decisions are his own, and therefore they cannot be blamed on anyone else but himself. Now let's focus on what this ancient passage has to say about this prudent man, this wise man. It says that he foresees danger. That is, he recognizes when trouble is brewing on the horizon because he keeps his spiritual radar locked in the on position. For a man to attain to wisdom, he must permit himself to feel. He must be able to sense. A man's ability to protect himself and others from imminent danger is dependent upon his ability to sense that danger in advance. If we're prudent, we will be able to foresee danger. But what good is it just to foresee danger if it doesn't lead to some sort of action? So what action does the prudent man take according to this passage whenever he foresees danger? Well, it says that he foresees danger and responds by hiding himself. A prudent man takes cover and he conceals himself when he sees danger heading his way. Now, why does the wise man conceal himself? He conceals himself because his experience has taught him to conceal himself. A wise man becomes wise by learning from his mistakes and seeking to avoid repeating them in the future. Now, the prudent man was not always so wise. In his youth and inexperience, he marched carelessly into the very heart of danger and evil. But those decisions came with penalties attached. As the young man gains knowledge and experience, he discovers the wisdom in hiding himself from coming danger. This prudent man was once a simpleton, much like the one described in this passage. It says that the simple man goes on towards the danger, and he suffers for it. I believe this passage carries a unique significance for us today, as our generation faces some of the most dangerous economic and geopolitical times in recent memory. And never before have the world's economies been so interwoven and so interdependent, and never before has mankind experimented with paper currency to the extent that he has in our modern era. If you've been listening to this show for some time, then you already know the numbers. The United States has a national debt of over $17 trillion, and when you lump in the unfunded obligations that America owes in the future, you come to a grand total of over $120 trillion in future debt. Don't allow your mind to gloss over these numbers. Embrace them. If you never truly admit to yourself that America is in deep financial trouble, you will never come to terms with your responsibility to protect yourself and your family from the coming danger. It's important to realize that someone is going to have to pay this $17 trillion national debt. It is not monopoly money. The interest payments alone on this monstrous debt could easily dwarf the entire government budget if the debt continues growing at its present rate. And when interest rates, which are being held down artificially by the Federal Reserve, are finally permitted to rise, the increased interest will further compound the burden of our nation's debt. Now, the government is either going to pay this debt or it's going to default on the debt. If America defaults, low interest rates in America will be a thing of the past, as investors will demand a higher risk premium to lend money to America in the future. However, if the U.S. attempts to pay off the debt, it has two options: pay it honestly or pay it by stealth. The most likely method that the U.S. will use to pay off its gargantuan debt will be through inflating the U.S. monetary supply. This is what we are witnessing now with the Federal Reserve's aggressive monetary stimulus efforts. When more of anything exists, economics explains that the value of that thing declines, however so slightly. For example, if you owe $1 million in an economy that only contains $2 million, your debt load is much more of a burden than if the total economy contains, say, $2 trillion. By inflating the currency, the feds can help diminish the sting of the national debt. But of course, with every action comes a reaction, and the reaction to this action would be widespread consumer price inflation. The costs of everything would go up dramatically and would continue rising. This is one exit door that is available to the federal government. Now, given all of these realities, it's time to ask yourself, is this danger that lies ahead severe enough that it warrants me to take cover and protect myself and my family? I cannot answer that question for you. That is a decision you will have to come to on your own. All I can do is tell you what I believe and what I am personally doing. And what exactly am I doing? I'm preparing myself, and I'm taking cover. If widespread inflation occurs, which is what history clearly shows is the most likely outcome to our current situation, I will be as prepared for that reality as I can be. I used to live in the city. Now I live so far out in the country I can barely receive a cell phone signal. Why? Why did I do this? I did it because I believe that America's cities are going to be a very dangerous place in the months and years ahead. Not so long ago, I was living in the urban sprawl of Houston, Texas. Now I privately fear for those who live there. As the statistics show over and over, many Americans have become extremely dependent upon the government for their needs, and more are joining their ranks than are joining America's workforce every single day. The boat is rocking, and the Titanic is tipping. Currently, over 82% of all Americans live in what are now known as high population areas, and only 18% of Americans today live in truly rural areas. Our dependence upon the food supply chain here in America is also very concerning, as very few of us are capable of producing our own food supplies. I have no doubt that when the bill finally comes due, riots are going to break out in the streets of America's largest cities. I don't say this to worry you. I don't say this to concern you or cause you fear. It's just simply a reality. Some cities will be run by mob rule. Anyone paying attention can sense the tension in the air. Americans are angry. Their view of Washington, of Congress, of the White House, they're all currently at staggering lows. The ever-widening NSA scandal, too, has served as an uppercut to America's reputation both within and abroad. In conclusion, let's just consider a few things that we can do to take cover from this type of danger. If you believe that inflation is eventually coming to America, what have you specifically done to prepare? Here's some ideas. Focusing on the key investment areas that have risen historically in times of growing inflation could be one good thing to do. These include something I call PACE. P stands for precious metals, A stands for agriculture, C stands for commodity, and E stands for energy. These are 4 areas that have historically done very well in times of inflation. You can also lump in real estate into that list, as it too is a real hard asset, but with a twist in the fact that it provides excellent tax benefits, tax-deferred growth, and monthly cash flow, which can be increased right along with inflation. Having your own business is another powerful way to prepare for inflation. After all, like landlords, business owners can raise their prices along with inflation. Those living on fixed incomes or working for a fixed salary or fixed hourly rate will bear the brunt of higher inflation, as they have no way to automatically increase their paychecks. You can also gain access to foreign currencies as a way to hedge against a falling dollar. And finally, you should consider your debt loads. Not only should you try to make them more manageable, but it's also important to make sure that they're focused upon a fixed interest rate. As we've mentioned on the show already, interest rates have nowhere to go but up, so why not lock them in now while they're so low? So let's seal this wisdom nugget in our hearts. Proverbs 22 verse 3, the prudent man foresees danger and hides himself, but the simple go on and suffer for it. If you're prudent, what steps are you taking to hide yourself and your family from the calamity that lies ahead? Well, friends, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It is an honor and a privilege to be a part of yours as well. You know, it's more important than ever, friends, to put together a financial plan, to have a strategy going forward. If you're looking for creative life insurance strategies or looking for an income that you cannot outlive, be sure to call our offices at 800-609-5530. That's 800-609-5530. Together with our team of advisors around the country, we'd love to help you craft a financial plan that allows you to be a good steward of the resources that have been placed into your life. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. God bless.
All of the information contained on Follow the Money Weekly Radio is strictly for informational and educational purposes. The views and opinions of all guests, including our sponsors Tom Cloud and Jay Peroni, are their own and do not necessarily represent the views of Jerry Robinson, FTMDaily.com, and or Robinson Media Group, LLC. Jerry and Jennifer Robinson do hold their insurance licenses and may offer consulting on life insurance and fixed retirement income products. Remember, never do your financial planning through podcast or by radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.